Hello and welcome to a fresh new episode of MC Explains, an investor education initiative brought to you by Moneycontrol and Invesco Mutual Fund. A quick look at the monthly data released by AMFI will show you that in the month of September 2024, equity mutual funds witnessed large net inflows worth about Rs 34,400 crore. What stood out though was the quantum of inflows into sector and thematic funds at about Rs 13,254 crore. Although inflows were lower than the roughly Rs 18,000 crore in August, inflows to this category have risen steadily and substantially in the last few months. Now that's a huge amount of money heading into this category of equity mutual funds. Just to give you a sense, elevated inflows since May have meant that the category assets under management has increased 38% till September 2024. That's just in 4 months. This category also has the highest number of schemes at 183 on last count on the 30th of September 2024. I'm sure you too have a few sector funds in your portfolio, and if not, are tempted to get a piece of the pie. Sector and thematic funds might be the flavor of the season. However, let's not rush into any investment decisions before analyzing risk and some other parameters. So first, let's understand what are these types of funds. As the name suggests, sector funds invest in stocks from a particular sector. It could be a banking sector fund or a healthcare sector fund. Thematic funds also invest in a limited spectrum of sectors, but rather than focusing on a particular sector, the focus of the thematic fund is on a theme. What does one mean by a theme? A theme means any aspect of an economy which can drive revenues for a particular set of companies. For example, while banking and healthcare are both sectors, infrastructure is a theme which will include companies that are from the oil and gas and metals sectors. Similarly, manufacturing could be a theme, consumption could be a theme, and so could a portfolio made with a quality filter or an ESG filter. Some of the newer thematic funds have themes such as manufacturing, automotives, special opportunities, among others. Hence, while a sector fund has a very narrow sector focus, a thematic fund is broader in its scope for stock selection. Both types are still pure equity mutual funds. What is it about risk in these funds that you need to understand? If you were to plot these two categories of equity mutual funds on a risk scale, they would most likely feature above all other types of diversified equity funds. Among the two, sector funds are considered riskier than thematic funds on account of a highly concentrated sector exposure. The technical risk of the portfolio can change depending on when you measure it. A quick look at the historical standard deviation data, which measures the volatility of returns, does show a larger number of sector-based funds having a higher standard deviation than their thematic peers. However, keep in mind that the risk of each fund is different and you should check the specific portfolio risk before investing. Now let's take an example and say that you are invested in a banking sector fund. Banks have a dual role in lending and borrowing, and their overall profitability is impacted by the interest rate cycle in the economy. The rule of thumb that's been witnessed historically is that banks tend to have a higher profitability in a rising rate cycle. This happens because the revision of lending rates upwards happens faster than the revision of deposit rates, which are the cost of funds for banks. Typically, deposit rates of savings accounts do not change quickly in response to the interest rate cycle, and people hold that money for a long time. Fixed deposit rates are also defined for a fixed period. Loan rates, on the other hand, can be linked to a floating rate benchmark, and the change in the rate can happen much faster. Thus, when interest rates are going up, banks are able to revise their lending rates sooner leading to higher interest income, whereas interest due on deposits takes time to change, thus costs take longer to increase, thus improving profitability in the near term. Over time, the situation does tend to normalize. Nevertheless, most banking stocks will benefit in the rising rate cycle. And by that virtue, a banking sector fund tends to do well. The opposite can happen if interest rates start declining. Thus, stocks from the same sector react similarly to macro changes, making a sector-focused fund one that has concentrated risk. There are other issues like government policies, raw material prices, demand dynamics, and so on, which impact different stocks from one sector similarly, but do not have an effect on stock prices of companies from other sectors. For this reason, sector funds are considered highly risky. Thematic funds in reality include a few sectors, maybe not as many as a diversified equity fund like a large cap or a large and mid cap, or other similar market capitalization based categories. Hence, both sector and thematic funds have a relatively higher concentration risk. There is also an element of cyclicality in sector funds. If one or more factors which impact stocks in a particular sector are positive, it can be considered a good entry point for the sector or thematic fund. At the same time, you have to be sure to exit once the revenues and growth impact of a positive factor have played its course. In case of the example above, a favorable currency movement is a positive factor for IT companies, but won't last forever. Similarly, a good monsoon tends to boost consumption-linked stocks, but the tide could turn in the next season. Hence, you have to be very nimble with sector funds. Can't just buy and hold for the long run. If that is a strategy that you want to follow, it may be better to move towards diversified equity funds. So the question is, should you invest in sector or thematic funds at all? Ideally, if you are just starting out in your market-linked investment journey, jumping into specific sector funds may not be the most efficient choice. Broad-based thematic funds may work better. However, you will need to filter and analyze individual funds to see what is broad-based and in which segment of the economy. Investors with good amount of experience in equity investing can opt for such theme and sector-based investments, provided they understand the risk of concentration and are also able to identify entry and, more importantly, exit points. How much you allocate to a particular sector or a thematic fund will depend on your overall equity portfolio and your own risk profile. These funds are essentially added to boost returns from an immediate favorable wind in a particular sector. For example, there are several transport and logistics thematic funds being launched in anticipation of supply side infrastructure improvement being undertaken by the government. At the start of this century, IT sector funds were the rage but collapsed as a result of overvaluation. Many retail investors lost money and several funds across the globe shut down. In 2008, infrastructure funds in India also suffered a phase of very poor returns post the market peak. Hence, don't think of these as a strategic long-term investment. Such funds are good for brief tactical exposures. Invest in them only if you can handle the risk and actually understand the sector dynamics. There are several new sector funds being launched. It may seem exciting to invest today. However, if you are going to do that, be sure you have a defined timeline of investment and an exit strategy in place.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.